Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 27th of July as we record. Today is one of the favourite days of the year for our companies writers, that morning when it feels like almost every FTSE 100 company reports at the same time. With that in mind, we have a bit of a large cap theme this week. We will be discussing Centrica, potentially in the political crosshairs again following its interim results today. We'll also look at St James's Place, whose shares have taken a bit of a battering this morning on the back of its own half-year figures. And we'll check in on GSK, which reported yesterday as well. We're also going to be discussing one of the big market success stories of recent years, luxury stocks. That's our cover story this week, encompassing all the big names from continental Europe and taking in another FTSE 100 member, Burberry, as well. Joining me to chat about all of this are Alex Newman.
Hi, Dan. How's it going?
Very well, thank you. And Mike Fahey. Hi, Mike.
Hello, Dan.
Jennifer Johnson will be along later on in the show as well. Centrica, then. Results today, Mike, you covered them for us on this occasion. The figures, we'll start with the figures in and of themselves, generally above estimates, better than expected.
Yeah, so it's always something of a roller coaster when you look at Centrica's figures because of the distortion that the energy price cap has. Centrica, obviously, its biggest unit is British Gas. It now supplies about a quarter of UK households. And when you look at the first half of last year, the results look terrible. It lost just over £1 billion. And it's largely just a timing issue with the cap. So last year, after Russia had invaded Ukraine, you got this huge run-up in gas prices, but it was still charging the same price to customers until governments allowed for subsequent increases in the cap. And those massive spikes, I think the first one was 50%, the second one was about 80% over the course of last year, then meant we were all paying a much higher price for our energy. But this year, as gas prices have fallen, the shoe's on the other foot somewhat. And so this year, it's recorded a first half profit of 6.4 billion.
Yeah, I suppose the shoe is on the other foot in that regard. But part of the reason these results are being criticised in some quarters is because the price cap is working the other way now for consumers as well, i.e. that cap is still pretty elevated, but Centrica is able to reap the benefits of lower prices itself while everyone else is still paying a high amount. So in the context of that, these figures, I think, for most of its divisions were, better than expected. There's a buyback in there as well. I think it's been increased. Is that what I'm, getting to here is really, as I said at the top, could this be a situation where politically it's getting a bit sensitive again and, politicians will want to, have a say on that in the face of public outcry?
I think there is a distinct possibility there, but I suppose the one mitigating factor, or the one factor Centrica has on its side, is the massive disruption there's been in this market over the past 2 or 3 years, with suppliers failing left, right, and centre. If Centrica, as it has today, it talks about the levels of investment it's making and the requirement for this more sustainable market, investing in the rough gas facility so that can somehow mitigate the swings in prices when spot prices in energy markets go up and down. If it can talk about those kinds of investments, it then becomes a little more difficult to treat it as political football.
Yeah, that rough gas storage station obviously was closed down a few years ago, reopened
in October last year,
yeah.
And they've invested in it already in increasing capacity, and they said today it now has about half of the UK's gas storage.
We should talk about those other investments as well, though, because it did sort of set out a bit of a strategic plan today as well. A decent amount of investment committed for the next few years, or certainly more investment than some analysts had anticipated in terms of what it will be doing and where.
Yeah, so the idea with it is as I mentioned earlier, just a more sustainable level of growth. So they're talking about spending between 600 and 800 million pounds a year on, and committing half of that to projects linked to green taxonomy, so renewables projects or other kind of mitigation to long-term net zero type projects. Now, some of this, that all sounds very kind of grand and ESG, you know. There may be some people who listen to this who think straight away, oh, it's woke nonsense. But the point to it is that when you look at plans for homes, say, even where there's been this reliance on gas boilers for years and there will be an eventual switch to heat pumps, then the infrastructure it has, a lot of it is going to become outmoded, outdated. So it needs to make these investments as well.
Yeah, I think as well they're trying to balance that, of course, with, as you'd expect, with a good level of return, but also trying to keep debt to EBITDA below 1 times, I think, over the medium term as well. So, trying to probably avoid some of the pitfalls we've seen with other utilities while nonetheless making these investments.
And the pitfalls it had itself until a couple of years ago, they're talking about today and this strategy being the end of what's been quite a massive turnaround for the business. It's sold off a bunch of the upstream oil and gas assets, which really did cause massive fluctuations to the results a few years ago.
Alex, I think you have some thoughts on Centrica and in the round, if not these results specifically, maybe a bit of both.
Yeah, I was partly looking at rewinding to almost exactly a year ago when we had a government that was sort of essentially on holiday trying to pick the next prime minister. But energy market forecasters, as Mike alluded to, were warning that household energy bills were going to really balloon over the next year. So we already had the windfall tax on North Sea energy producer profits, of which Centrica, given its gas production, was subject to. But there was this emerging sort of bear point for Centrica shares and other utilities that it was going to be the next in line for a super profits tax, which, judging by the headlines and the coverage of the results this morning, it's very much been taken that it has stepped into a sort of super profits, super profitable earnings season. Of course, with the caveat that, as Mike also mentioned, this was the recovery of costs from the timing of the standard variable tariff cap. So it's become suddenly the next political football. And yeah, I also wouldn't be surprised if there are some moves to potentially check its profitability. That all said, part of this, is kind of its profits today are sort of a reflection of the slightly awkward, slightly messy regulatory Ofgem setup we have in the UK, and I think the other point, I suppose, from a shareholder's perspective, is to almost look past some of these swings, and to what they're saying today is quite compelling from an investor's perspective. So they're talking about a lot of confidence in making 20% plus returns on capital, and they've got loads of projects that they've said that they can target. So there is this opportunity to transition to a sustainable equity growth story. They are priced at a political football level. They're still on single digit earnings, even though in the same breath that they're more diversified now. They're out of the primary energy production, which was a tricky legacy operation. But then they have quite a compelling story to tell as part of the green upskilling of the economy. I think on balance, I think the risks are probably worth it in the share price at the moment, because really, and we come back to this, with so many industries we talk about, the government has to work with Centrica to be part of the energy transition and energy security story. So yeah, it's easy to just stare at the headlines and think, okay, huge levy coming, but there is an emergent business here which I think looks quite compelling at the current valuation.
Is it quite similar, valuation aside, but is it quite similar to National Grid in that regard? Regulated, business utility that nonetheless, with the energy transition, is certainly making noises about being much more of a growth type business now, rather than a dividend mainstay, or trying to be both, really.
Yeah, and National Grid was a company that we include in our ideas section. I don't think we're giving too much away to say last month. I think the strength in the National Grid story is that they're now kind of half of the business is focused on North America and the eastern seaboard. So, from a kind of our profits okay story, you would probably back businesses based in America, relative to the UK. In that sense, it's good. And also you've got the Inflation Reduction Act in the US, which is this huge potential tailwind to the investments they're planning on making there. Maybe given the sort of gas legacy infrastructure that Centrica has, and National Grid, the infrastructure is a little bit kind of future-proof compared with that. There's you can make a case for valuing their assets a little bit more highly. But yeah, they're kind of both part of the same story that is potentially emerging from businesses which a lot of investors overlooked in recent years.
Mike, on the Centrica valuation, is that a fair assessment from your point of view? The supernormal profits may be ending in one regard, but there's growth potential there.
Yeah, I think so. So I don't know whether this should be the opportunity I take to blow my own trumpet. I mentioned last year's idea, and it was kind of just after Russia's invasion, and at that time I think they were priced at 77p, so they were up 70% since then, and so maybe a less compelling case now than they were then. But I think there are two other things to consider. One is that it seems at the end of one part of its lifespan, when its valuation was really battered because it was a bad company. One of the things mentioned this morning is the services arm. Got 7,000 people out fitting gas boilers, etc. at the moment. Obviously, they're training some of those people to do heat pumps and other things that will help towards a green transition. That's lost money for years, but has actually turned a profit in the first half of this year.
So yeah, even that side of the business, the side with which people have the most day-to-day contact, and sometimes that contact isn't always satisfactory.
Yeah.
Even that is, well, from Centrica's point of view, doing quite well at the moment.
Yeah, but overall, it's the position of strength, really. It's the fact that it has a quarter of households. It's good at customer service, and it's not a great thing you can say about many utilities companies, and most of us have horror stories in dealing with them. But one of the reasons why it's become the kind of default choice is because it's geared up for it, and it served customers reasonably well at a time of big upheaval in the market. And I think that makes people less... having been scarred by some of this, it makes them less willing to jump again because I know there's an argument that as the government tries to encourage switching again as the market normalises, that's a threat to them. I know Chris O'Shea obviously said that he thinks it's an opportunity, but I do think, given what's happened in the last couple of years, it will probably win as much new business as it loses in that front.
Yeah, I think there's definitely be some people who would be averse to British gas, but as you said, the pool of options is thinning, and it might make them think, well, bigger is better.
Yeah.
I was certainly one who was... I was with Bulb for my sins, and now I've been moved over, and I haven't had a functioning electricity meter for a year, but that's a non-gas different story for me to complain about on a different podcast. Let's talk about something entirely different now, our cover story that we're going to stay with you, Mike, because you wrote it. One of the big market narratives of the past couple of years, although in some cases people have only kind of woken up to it in the past few months, perhaps, is luxury goods stocks and, the luxury goods companies, all these, heritage names. They tend to be European listed. Talk us through sort of the piece and sort of the thinking behind it and the context to that, first of all.
Sure, yeah. Well, as you just mentioned, there's some additional reporting on this by my colleague Mitch Labiak. Mitch looked at the at some of the demographics that have shaped this over the years, and it's not too difficult to find stories in the press on wealth inequality and the growth of that, and it's sort of really taking that and thinking, well, if there is wealth inequality, and it's seemingly not something that looks like it's being fixed anytime soon, where is the upside? Where do you benefit from this as an investor? And luxury goods seem like quite an obvious place to look. When I started looking into it, and you looked at some of the long-term trends by the consultants like Bain and Deloitte and BCG and others have mapped out for this industry, it's grown pretty much double the rate of global GDP for the last 25 years or so. And the forecasts up until 2030 are for pretty much the same thing.
And as I say, these companies, have done fantastically well in a lot of cases. Talk us through some of the big names. I'm sure people recognize them, whether they're investors or not, just by, the power of the brands. But so talk us through who those are, and then we can kind of go on to individual prospects.
Sure, yeah. So LVMH, Louis Vuitton Moet Hennessy, to give it its full title, is the real kind of powerhouse in this market. It has been a big consolidator. It's got a market cap of over 400 billion euros. And what it has done and why it's so well liked by analysts is that it has two principal engines in the business. One is a Louis Vuitton brand. The other one is a Dior brand. And they have been these kind of amazing cash-generating machines for it, which has then allowed it to pick up other brands along the way, to reuse that cash to spot potential bargains and bring in other brands. And it really has been the kind of behemoth of the industry, really. Similarly, Kering, which owns the Gucci brand, has operated in a similar sort of way, snapping up businesses along the way too.
And the structural growth kind of trends are still in place. I think it's fair to say, as you mentioned, Mitch wrote about that as part of the piece. There's still sizable markets which are growing, certainly emerging markets, for example. As more people enter the middle class and upper middle classes, more people are able to afford these, in some cases, very expensive products.
Yep.
That said, we have seen in recent weeks or the last couple of weeks, some of these share prices come off a bit because, it's a similar case of, perhaps that supernormal growth slowing slightly. LVMH just the other day, a couple of other examples as well.
Yeah, so one of the amazing things I think about the industry since the pandemic, really, was that it didn't slow down during the pandemic. If anything, it picked up. China, as you talked about the demographics, Chinese buyers before the pandemic were about a third of the market, and that market pretty much closed overnight. But then when you had scores of people in the US sat there with stimulus checks burning a hole in the pocket, that they became the replacement for that. And the growth continued and was even stronger over the last couple of years. But as that has unwound this year, that has kind of that's been the main concern with LVMH and Richemont and some of the other companies that have filed results recently, that although China is now bouncing back, the US market is pretty much flattening off.
I suppose there might be a question about China's bounce back as well, given the lack of bounce back from its reopening we've seen in other quarters. I suppose I'm thinking of tourism to an extent, but also commodities. People expected a big bounce, though that didn't happen. Luxury, are people still expecting an increase as a result of, I suppose, more travel and things like that? Is that still something that can be not guaranteed, but, relied upon to an extent?
Yeah, well, in luxury, it is still really strong. You're talking, having looked through quite a lot of the analyst notes on this, they were talking about 20% or so sales growth this year from Chinese customers within China and also within the Greater Asia area. So, anyone who's ever been to Hong Kong or Macau in the last decade won't have fail to notice the massive amounts of boutiques, the same brands having 8 or 9 stores within pretty small locations. And maybe we don't see as many Chinese tourists coming back to London yet, and some of the luxury brands might argue that's because of the changes to the VAT rules. But it does seem that revival is happening in other parts of the world.
Alex, what are your thoughts on the luxury sector and prospects there, or certainly from an investor's perspective at this moment, given the big run-up?
Yeah, I mean, it's such an interesting sector because, I mean, as Mike sort of alluded to there, the air is so rarefied at the top of this tree that you're talking about kind of business models and I suppose valuation cases which are sitting on quite disconnected stories to the broader economy. So I suppose at the level of a Burberry or which I know Jen sort of covered earlier this year, they're maybe having to play in the field where price architecture, the vagaries of the retail cycle, China being open or not open for business have a more sort of material effect on earnings and sales. But I mean, when you get up to a company like Hermes, which I think we're not mentioned, but along with LVMH has been the other complete story in this sector over the last decade. You just have an unreal business which I can't really think of any parallels. To me, it's a little bit like if there was one company in the world which owned the only diamond mine in the world, and there's massive demand for diamonds. So their waiting list for its products, which in the core division, sort of core business, doesn't really change. The kind of product cycle doesn't really change that much. You've got a price insensitive repeat and global customer base where if Russian the Russian elites are no longer able to travel very very easily, it doesn't matter at all because you've got hundreds of people queuing up to pay well over the odds for their products, and I mean it explains why I think it's the most highly valued company in this space. It's also one of the most well followed. Despite that, it's on something like 46, or I think you said in the piece maybe 47 times forward earnings.
Yep.
But it has this dynamic which you just do not see anywhere else in other sectors, whereby it can basically maintain a kind of 20-22% operating profit growth each year and a 40% operating profit margin, and kind of mandate that. So it just moves at that pace, kind of throttles sales growth appropriately. So they choose kind of who's buying the product, and if you sort of extrapolate that 10 years into the future, then it falls to a kind of 9 times earnings business. Like, we definitely shouldn't be looking at the stock prices, but stock price is going to be in 2030 because that's probably too far away. And I think there are risks with businesses like this. There's huge family concentration in the shareholding, and there are always risks to brand and brand equity. But that explains why people would still buy them at this kind of price, which is almost as much as seems almost exorbitant as a Birkin bag.
So I asked obviously why Hermes is so fabulously much more expensive than anything else in this sector. One of the analysts made the point that it's principally leather goods that they do. They don't do jewellery, they don't do shoes, they don't do things that are prone to cycles of fashion. They do leather, which is one size, it's standard for everybody, and it has tremendous margins. So,
and it's never changed, as you say in the piece, Mike. The same thing they've been selling for years. So,
pretty much the same range, yeah.
Nice work if you can get it.
Indeed, yeah.
Let's end on Burberry. Jen, who's here as well, as you say, Alex did write about Burberry a couple of months ago, but Mike, you touched on it briefly at the end of the piece. Given the context of these high valuations and maybe some slightly tougher times in the US market, we look at where the best value is. But let's stick with Burberry for now. How do you see their fortunes? This has been a laggard somewhat of the European story in recent years.
It has, yeah, and Jen pointed much of this out in the piece as well. But part of the reason for that was its brand's overexposure. One of the the point Alex just made about Hermes almost tailoring its growth because it knows it can set levels of supply and demand seems completely inelastic. But with Burberry, it was almost the opposite, really. The distribution got away from it. Its products started to appear everywhere. It lost its cachet as a brand, and it has quite a lot of fashion. It has a big fashion component to its whole product mix. So if that loses its luster, then you're really starting to struggle. You end up with a lot of the ranges in outlet stores. It's being sold on the cheap, and it takes a long time to try to rebuild that brand prestige, really, in a market like this.
And we're not necessarily saying it's going to be, a new LVMH, Jen, but welcome to the show. But you, nonetheless, there are signs of better times to come there with Burberry.
Yeah, I would say so. And as Mike was kind of saying a minute ago, it's with a lot of the luxury brands, it's about heritage and kind of still trading on this heritage tradition. And Burberry, for a bit did become associated with hooliganism. And someone, I can't remember who, but someone called it the Burberry check, the iconic Burberry check, called it the ultimate symbol of nouveau riche naff, which is, if you're a luxury brand, completely not what you want written about you or said about you or thought about you, really. So I don't think Burberry is going to become an LVMH overnight, but it certainly does have a few products that still have this heritage prestige, the raincoats being one of them. And I think particularly, they've got a new creative director who is kind of working to build the brand back up. And I think as the decades kind of wear on from when Burberry was this overexposed, kind of negative associations brand, it will, especially in other markets outside of Europe, start to regain some of that prestige if current management plays its cards right. It's nowhere near, especially the kind of French fashion houses are nearly untouchable there, really. So your Hermes, your LVMH. But Burberry is it's going to have a go, and a lot relies on, I think, luxury spending in China continuing to grow, which is obviously not a given at this point.
Mm. Yeah, and those new collections as well, I think, as you say in the piece, Mike, out in September, it seems. So that will be the first test of that new range as well.
Other luxury good collections are available as well.
Well, indeed, of course. I mean, I have no idea the relative merits of these things in terms of the actual products themselves. But that is our cover story this week. Do check it out if that has piqued your interest. But we should move on because time is getting on. Another FTSE 100 company now, St James's Place. Alex, now, again, this is a company in my kind of past life I covered quite closely, and I'm sure many of our listeners will know it as well, the wealth manager. It certainly has a lot of clients. It certainly puts a lot of effort into marketing. And, from a financial perspective, it's done very well over a long period of time. Had its half-year results today, and the fly in the ointment, really, from investors' point of view, is, it seems, not least the problems that all asset managers, wealth managers are facing at the moment with difficult markets, but also new regulations are forcing it to scale back its premium fees somewhat, shall we say.
Yeah, so I mean, maybe it's just it's kind of useful to kind of almost dovetail a previous discussion on luxury with St James, because they are in some ways the luxury wealth manager. They are, as well as being having a lot of clients and being the largest wealth manager, there is a kind of prestige heritage brand to being a client of St James, and it has kind of almost defied expectations for a long time in its ability to keep customer funds and those clients very sticky. There are some great economic moats to wealth managers because, there are sort of, kind of high, either psychologically entrenched switching costs for their clients to move. How do I know if another provider is going to be better, or my wealth manager is going to understand me? as well, or they're going to be a marquee name, whatever. Which St James has been able to hang on to. So the big news today, is, as you alluded to, is their anticipation. They're trying to get ahead of the FCA's consumer duty, which we've talked about a couple of times on the podcast. And in doing so, they've taken this quite chunky hit, £859 million to their sort of assessment of their what's known as their European embedded value. We can sort of park that to the side for a minute, because what they are hoping to do is anticipate one of the potential avenues of this consumer duty regulation, which is the fees you're charging to long-term loyal customers. Their solution to this is to basically what they've said is reward clients with long-term investments through the introduction of an annual product management cap on bond and pension investments after they've been invested with us for 10 years. So that's 85 basis points, which, I think for some people would say that's quite high already. But that cap in itself has taken a big chunk out of their future earnings already. So yeah, it's either, depending on your perspective, it's either sort of drawn a line under things, or maybe open a can of worms for how they navigate this brave new world of consumer protections for everything financial services.
Yeah, I think that latter aspect is probably the fear, and maybe part of the reason, as much as the move itself, as to why shares are down 15%. Because they say themselves that. What do they say? They say the consumer duty, is an ongoing requirement, and as such, we should expect there to be further changes identified over time, resulting from this enhanced standard of care. So that does imply more moves could be on the way, albeit maybe not as big as this one. But
yeah, I still personally don't really understand the consumer duty and I don't think anyone truly does in how it's going to be applied. But I definitely don't understand why 10 years has been sort of determined at the point at which you'd like to start rewarding loyalty. Because, it's an arbitrary number. I'm sure they have their reasons, and they're saying 65,000 clients are going to get immediate benefit from this. But if I've been invested with St James Place for 8 years, I would be saying, well, why not me? Is that not loyal enough for you? And then where do you draw the line, I suppose? So this is a crack in St James's armour, really. Critics have long accused it of being very opaque on pricing. And if the consumer duty is going to be heavily enforced and inject kind of transparency for all consumers, I do struggle to see how this can't be a challenge for, their particular business model. It explains why the shares are down 15% today.
Yeah, and they used to say as well, and I think most people in the industry would agree that, most companies in the industry, because they've been making similar noises along the lines of what you just said about the difficulty in understanding how this will play out. SJP say the subjective nature of the consumer duty regulation also presents a challenge to all firms, as the expectation of leading practice will only become clearer over time. I think the FCA does like to do this sometimes, where it kind of says, well, it's up to you, but we will penalise you if you get it wrong, in an effort to encourage people to go too far. And the FCA thinks that's better than the opposite. But that does also mean people are feeling their way through, and they don't really have any idea of how hard they may be cracked down upon.
Exactly, yeah. Stage. By booking this charge now, it's kind of it probably has it has changed the conversation itself. Regulation is formed sometimes in the sort of back and forth between what companies are going to do and also what the regulator wants them to do. So they'll be hoping this is kind of they've met them halfway. But yeah, I think it's hard to see this not resulting in more bad news further down the line.
Well, they say it should help client retention as well. Making these offers, but the fact is, despite many trade journalists expecting otherwise for a long time, their client retention has long been very good. They say, the top of the latest figures, it's still 95.6%. So, it's hard to improve much on that figure anyway, but maybe that's a silver lining for them. Yeah. We'll see. The final segment of today's show, though, our final FTSE 100 company was one that reported yesterday, and that is GSK. We've spoken about them before a few months ago. Yesterday, though, figures, Jen, guidance raised, looking like a decent set of numbers there.
Yeah, absolutely. It is looking like a decent set of numbers, but with a couple of caveats. the things that are driving sales are the things that have been driving GSK sales for quite a while now. It's the shingles jab, Shingrix, and its HIV franchise. So that really hasn't changed. This is one thing to note, though, with, as you know, kind of the nature of the pharmaceutical industry is such that if you're a company that doesn't have a very stocked pipeline, it's going to take you decades, realistically, just because, you know, trials take time, regulatory review takes time. And so it was only a year ago, really, that GSK hived off Haleon and said, you know, we're now focused on vaccines and kind of specialty pharmaceutical drugs. So this turnaround isn't going to happen overnight. And the thing that investors need to be aware of is, you know, coming patent cliff. So when drugs lose exclusivity and generics come to the market, this is just something that's, if you're looking at GSK today and you're thinking, oh, this is cheap, which it is, I think shares are trading on a forward PE for the full year of less than 10 times, which is a lot lower than kind of comparable pharmaceutical companies that tend to be more around 16, 17 times. So, yes, it's one. In the short term, GSK is clearly doing well. An upgrade to guidance is always a good sign. But the longer term problems that we've kind of been warning about really for a while haven't gone away and aren't going to go away rapidly. That said, it's clearly a company that has a greater vision for itself. Its chief executive is, you know, doing a kind of good job of articulating that vision. Getting rid of the consumer healthcare division made sense for the company. So there are signs that things are moving in the right direction, but it's going to be somewhat touch and go for a little while, I think.
Yeah, it's a nascent turnaround story, it's fair to say, you know, given, as you touch on, you know, its struggle, certainly relative, the obvious comparator is AstraZeneca, you know, the other FTSE 100 peer, which has been going great guns by comparison in recent years. That said, you know, these things do come in fits and starts. The other issue for GSK, as we have mentioned before, and was maybe reflected yesterday in the lack of share price movement, despite these, you know, good results, guidance being raised on a number of fronts, is the Zantac issue, the overhang. I mean, it seems to me that, you know, despite better operational performance, the lack of share price move is people are worried about this you know, litigation risk from this the Zantac issue, basically.
Definitely, and that's not something that is going to vanish overnight. I think there have been a few positive signs recently. A judge in Florida threw out some claims last December. GSK settled out of court with another plaintiff in California last month. So there are signs that this is moving in a decent direction for GSK. But I think purely because of the complexity, the size of this legal action is obviously massive. The complexities of the US legal system, it is very difficult to say with any real confidence how this is going to go. You know, there have been provisions made for kind of further out-of-court settlements. What you really don't want, if you're a GSK investor, is these cases kind of going to trial, because that's where the real liabilities start to stack up. So, yeah, I think there's valid reason to still be concerned, but again, things are moving, or appear to have moved, in the right direction with some of the cases being thrown out.
Yeah, I suppose we should say, for people who aren't aware, this is, you know, the heartburn drug that was at one stage the biggest selling drug in the world in sort of late 90s, but now, you know, as you've alluded to, GSK is facing a mass of lawsuits in the US on various different levels over allegations about side effects from Zantac. In terms of its future, though, as well as the shingles vaccine, the HIV set of treatments, you know, there's been some progress there as well. There's been, I think, another one of those was approved in the EU this week, is already being sold in the US. Is that really where investors should be looking when they're looking at future growth prospects for GSK? Is that the area of biggest potential growth?
I think, at least in the short term, it clearly is. In the longer term, it's sort of hard to say and really dependent on the way that, you know, the various clinical trials that they have in the pipeline go. But again, be wary of the fact that this is concentrated in one disease area, and it is because of the kind of number of HIV drugs available, because this is not kind of a disease that is expanding in patient population terms as, cancers or dementia are. You would kind of imagine that the longer term reliance on growth in the HIV franchise is not likely to drive the company to longer term success. I think probably longer term they're looking at vaccines. They also had an RSV, that's the respiratory virus, a vaccine approved recently. Obviously they missed the boat on the COVID vaccine. It does have to diversify into kind of other disease areas. When you mentioned AstraZeneca, obviously the huge advantage that they have is they make a number of different cancer treatments, and they sort of understand that treating cancer is really treating 200 different diseases. So they have this specialism and subspecialisms within that. So that's a real advantage for them that GSK just doesn't have. And if it wants to, continue to grow or even compete with AstraZeneca at some point, it has got to diversify.
Thank you very much. That does bring us to the end of the show. We packed in a lot today, so thank you to everyone. Thank you to Alex. Thank you to Mike. Thank you to Jen. And thank you to you for listening. We will see you next time on another Companies and Markets show.